Spotify reported fourth quarter 2023 financial results this morning, and the quick takeaway is that the company is performing phenomenally well. Shares were up about 10% early in trading today. As I'm recording, they're up about 6 or 7%. But the big thing is there's momentum in every piece of the business. The subscriber numbers are improving, premium subscribers are improving, prices are going up, margins are going up, and this is even before some cost cuts take effect that were put in place in January. So there was about a 17% layoff in January. So we're going to see those operating margins improve even more in 2024 as those cost cuts kind of work their way through the system, especially for companies based in Europe. Layoffs take a little while to work their way. So it'll be probably 2 or 3 quarters till those full cost cuts are really realized by the company. But I think there's a lot of positive takeaways. So I'm going to dig through the numbers today and kind of give an early takeaway from the earnings report and then what I took from the conference call as well, because that just ended a little while ago. And management really laid out what they think the vision of the future is for Spotify. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they've got your top 10 stocks to buy right now. So let's go right to the report. With any Spotify earnings report, this is going to be the place you want to start. All these numbers are in euros, so keep that in mind from a financial perspective because it's a little bit different than most companies that are traded in the US. But I always start with what is happening with monthly active users. And there's 2 reasons for this. One, the premium subscribers, so the number of people who are actually paying for Spotify, is really going to drive their financials. Right now, the ad-supported business is just a fraction of what the premium business is. So from a financial perspective, that's going to really be the most important thing is how many premium subscribers are there. But the ad-supported tier is important for a couple of reasons. One, that's typically the way people start with Spotify. They're going to use Spotify on an ad-supported basis, that free tier, for a period of time and then transition to premium. That's typically the way that a business like Spotify works. And management has talked about this quite a bit. That's kind of like the top of your funnel from a marketing perspective. So you want to have that user base, that ad-supported user base increasing over time. Now, there's a number of reasons that the number of ad-supported users is probably going to grow faster than the premium users. Spotify is growing more in emerging markets than it is in more mature markets like the US or Europe. So it's kind of capped in the growth that they can have in some of those more mature markets. That's why you're going to see the ad-supported side of the business likely grow faster than the premium side, both from a user base and from a revenue growth perspective. The other thing is the ad-supported business just has more opportunity to grow. And I'll get to some of those numbers, but I think that is really critical for Spotify's financials long term. They need to make this ad business much, much bigger than it is today. So that's sort of the context of the numbers. And what you see is there's just phenomenal momentum. Over 600 million users now on a monthly active basis, up 23% year over year and 5% quarter over quarter. These quarter over quarter numbers are going to be really important for Spotify going forward because if you can maintain growth in that kind of mid-single digits range every single quarter, that's how you're going to compound your growth numbers at 20% plus on both a user base and then on the financial side as well. So this is very, very encouraging to see this kind of growth in the user base. Now, financials is going to be a little bit different. Premium up 17% year over year and 9% quarter over quarter. There's a couple of things going on there. Spotify instituted some price increases that hit late in the third quarter. So the fourth quarter is really when you're going to see most of that impact. That's a big reason that the growth number from a revenue perspective is much higher than from a user perspective. So just a little note to keep in mind there, but really good that they're growing that user base as they're increasing prices and likely increasing margins at an even greater rate. Ad supported up 12% quarter over quarter. This is where you want to keep in mind that the fourth quarter is the holiday quarter. So a lot of the brand spending that was going on a platform like Spotify is going to be brand related to the holiday season. So that's why it's probably going to be an outlier quarter from a revenue perspective. It just peaks a little bit higher in the fourth quarter than it does in typical quarters, but still 12% growth year over year. I want this to be much higher. I want this to be in excess of 20%, and management is working on that. But this is kind of the one thing that's holding Spotify back as a business and as a stock, is this not growing in excess of 20% on a compound basis. Gross profit really improving. There's a number of things that they've done to increase their gross profit. They've increased prices like I talked about earlier. That's going to increase the absolute gross profit, not necessarily the percentage, because Record labels are still going to take a percentage of their revenue, but on an absolute basis, the gross profit number is increasing at a rate even faster than revenue or the user base. So that's the kind of operating leverage that you want to see in this business. Again, operating leverage, this operating income number, negative $75 million. Not surprising, this is actually better than guidance. But again, you want to see this start to turn positive in 2024. And then cash flow, this is where you're starting to see a lot of improvement for Spotify. It really turned negative in 2022. And then as they went through cost cuts in 2023, we've started to see this really accelerate higher. Now almost $400 million for the quarter. I think by the end of 2024, Spotify can get to the point where they're posting $1 billion or more, or €1 billion or more in free cash flow on a quarterly basis. So a €4 billion run rate. And if that happens and revenue is still growing in the mid-teens, that's how you get another step change of improvement in the stock performance. Let's go to some of these margin metrics. This is something I'm always watching because Spotify breaks down the total gross margin is not necessarily as important as breaking these down between premium and ad supported. Premium, what you want to see over time is premium margins getting towards about that 30% range. And Spotify has bounced a little lower than 30% over time, but you can see there's a lot of volatility. So what we want to see is this really become much more steady right around that 30% number. So we're getting closer there. And each percentage point that you can squeeze out, that flows almost directly to the bottom line. So that's why that's so important. Ad supported, there's a lot of costs that go into this, not just from the ad side, but also for all podcast costs go into the ad supported business. But this is now up to 11.6%. This has been periodically positive, been negative. It's kind of been all over the map. So that's one of the reasons that Spotify's financials have been so volatile, is because this ad supported business has been extremely volatile. There's a number of cost cuts, both from paying for exclusive content that they made a bunch of deals during the pandemic. They've really cut a lot of those, the ones that weren't paying off, and then also increasing the scale in the ad supported business. Those should help improve these margins over time. This is a business that could potentially get to 40-50% gross margin, but it's nowhere near the scale necessary to do that. And so that's why, one, I think there's a lot of upside for Spotify as this improves, but also kind of the disappointing part of the business right now. Operating expenses is really where Spotify has focused on efficiency. And this is something that we have heard with a number of tech companies, and Spotify really falls in that category. Total operating expenses year over year were actually up 2%, but there's a number of reasons for that. These efficiency charges, this is things like severance costs that go into some of the layoffs that have been announced recently at Spotify. So that is where some of these costs are coming from. But all other expenses besides foreign currency movements, social charges, and efficiency charges are down 10%. So we're trending in the right direction from a cost perspective. But like I said earlier, it's going to take more time for some of these cost cuts to really flow through the system. So don't expect this to be a steadily lower operating expense number until at least the second quarter of 2024, and probably more like third or fourth quarter. That's when a lot of those severance costs and these social charges that they're talking about are going to start to flow through the system. So something to keep in mind as investors. And then this cash flow number, this is what is increasing just dramatically for Spotify. This is everything from cost cuts to price increases to the growing user base are impacting this. But you can see that the top one is just the quarterly free cash flow number. This is when layoffs started. It was right here. So you have a lot of those social charges, those severance charges. And this is when you're starting to see the operating leverage from the lower headcount and that user base growth. So last 12 months, generating almost $750 million worth, or million euros worth of free cash flow. Just a tremendous result and a tremendous turnaround in the business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, a couple of the things that are not really going to show up in the financial results are the things that are going to drive the business long term. The podcasting business specifically, I mentioned that gross margins are positive for ad-supported business, and the podcast costs go into the ad-supported business. But management said that the podcasting business specifically is still not even at break-even level from a gross margin perspective. So as that improves, as scale improves, as advertising improves, that should improve dramatically as we get more operating leverage in that business. So a lot of the improvement that we've seen over the last year is in music. And I think there's going to be just a steady drumbeat of growth there, improved margins, improved cash flow, just a business you can count on for Spotify. But expanding the business is what's really important. Podcasts are going to do that both from a revenue and a margin perspective, but we haven't seen that impact yet. The next leg of the stool is audiobooks. And this is really something that has just rolled out on a bigger basis in just the last few months. So audiobooks, there's about 15 hours included for premium subscribers in some countries. That's starting to expand the pie. And that's the way that investors should think about this is you're now bundling music with podcasts, with audiobooks. You're adding more value to consumers. You're going to eventually be able to charge higher prices, have them spending more time on the platform, and have lower churn. That's ultimately what you want from bundling products together that seem like they're maybe a little bit different, is you're adding value to different people in different parts of the value chain. So I think all of this is really positive news for Spotify. The biggest thing is that user numbers continue to grow. We're clearly on a path to getting to 1 billion users probably in the next 3 to 4 years based on the current growth rates. And like I said, I think Spotify has line of sight to €1 billion or $1 billion per quarter in cash flow. If they can get there and continue to grow the business as that cash flow number improves, I think this stock will do tremendously well. This is why I own it. It's the biggest holding that I have in the asymmetric investing portfolio. And I just love where Spotify is going right now. The one flaw is I want to see more improvement in the ad business. And this has just been something consistent over the last couple of years. I don't think they're improving ads quite as quickly as they should, but a lot of talk about this. And you can see that it's not driving the financials right now. So we'll see where that goes in the future. But I think if there's going to be another 10x potential in Spotify, it's going to be because that ad business grows to be much more than the fraction of the business it is today. But what do you think about Spotify's results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.